Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we are watching this hour. First up, rate cut bets growing ahead of the August jobs report. We're previewing the data and what it means for the Fed meeting later this month. Plus, Congress is back on Capitol Hill as the funding deadline looms, why one guest says a government shutdown seems, quote, almost certain. And Broadcom is set to report earnings after NVIDIA missed data center expectations. What to watch as chip companies look to navigate China hurdles. All that and more coming up on Market Catalysts. Let's get a check on the major averages here. First of all, we are seeing selling across the board, but particularly acute with big tech. However, even since the opening bell, or even since where futures were pointing, we have seen not as dramatic a sell-off. Right now, the Dow is down about 0.6%, 277 points. The S&P 500 down 0.8%, and the Nasdaq Composite down about 1% here. If we dig into large cap technology, we do see that there is more selling going on there. However, again, it is not that dramatic. You've got the likes of Amazon down nearly 2%, and a lot of red in terms of the breadth, pretty negative here today. But again, not a lot of dark red on the screen, which indicates more selling. And then if you look at the sectors in the S&P 500, only energy and healthcare in the green today. You've got large cap tech as exemplified by the XLK selling off, and the XLF, which is financials as well as industrials. So sort of a risk-on tone to start the trading month of September that we're watching here this morning. Of course, a lot of attention is focused on what's going to be going on Friday and the jobs report. So let's turn to that now. Rate cut bets are growing ahead of that report out on Friday. The CME FedWatch tool showing a nearly 90% chance of a cut in September. Joining me now is Robert Stockin, Citi Senior Global Economist. So Robert, as we look ahead to Friday here, do you see sort of a confirmation of some of the other weak job data that we've been getting as of late?
Yeah, this is the key question going into this Friday's report. And to me, I think it's very likely that we're going to get another soft reading on payrolls. If you look at the last report, the pace of job growth after those large downward revisions and the soft July reading is running at about 35,000 per month over the last 3 months. I think we're likely to get a modest pickup from that, but maybe somewhere close to 50,000. That would still be a fairly soft reading. Now, if we go back last year, we saw that the data were also soft around this period in the labor market, only to see the labor market accelerate later in the year. So this is by no means a guarantee that what we are seeing is a sign of genuine weakening in the labor market and the economy. But it is a very worrying sign, and I think it's going to pave the way for that September rate cut that to me seems almost baked in the cake at this point.
How do we know, though, if it is real, right? If it is a more significant downturn in jobs or something that's sort of more temporary or even seasonal?
Yeah, this is the key question. I mean, on the one hand, as I mentioned last year, we had a bit of a slowdown only to see things pick up. That might point to some seasonal issues in the data. And at the same time, if we look around, the data picture is quite mixed. On the one hand, layoffs remain quite low. If you look at weekly jobless claims, those have not budged very much this year. On the other hand, if you look at the consumer confidence report we recently got, consumers are saying that the labor market conditions are much softer than they've been over the last few years. So it is a mixed picture. To me, though, when I speak with corporations in the US and around the world, the most likely story here is that the tariffs and policy uncertainty is leading companies to pause expansion plans and perhaps hire less. That could help explain why layoffs remain quite low while hiring remains soft as well. So to me, it's hard to know from the data, but it makes sense from the stories that I'm hearing that you would see a bit of a slowdown in the labor market.
And Robert, does that also help explain why the tariffs are not showing up more in the data? If companies are maybe cutting down on their spending plans or even cutting costs instead of raising prices?
Yeah, this is the key question. And I think the first point to note is we are, by our assessment, starting to see consumer prices rise more materially from the tariffs. It's been slower to get off the ground. There's a lot of reasons for that. Companies have built up inventories that they've been able to run through without raising prices. companies have been waiting to see where the tariffs actually land before passing them on to consumers. But at this point, we estimate that about 30 to 40% of the tariffs is being passed on to the consumer. The rest of that cost is being absorbed by U.S. companies. And it might be, as you noted, that they are finding some other ways to offset some of these challenges by maybe expanding less or maybe also cutting costs in other ways without laying off people yet. That might be why that they're able to absorb more of these tariffs than expected. But ultimately, we actually just think it's a much slower, more drawn out process than we may have thought a few months ago. And we expect that 30 to 40% that's going out to the U.S. consumer, we expect that that's going to grow in coming months now that we see that the tariffs are durably at a high level and companies are unable to absorb it into their margins at these levels. So bottom line, it's a delayed process. Some of that may be going on, the offsets that we discussed, but I think more likely you're just going to see more pressure on consumer prices in coming months.
So if it's a coming month situation or a more extended effect on prices, does that mean it's not, quote unquote, transitory? And what are then the implications for the Fed, not just for cutting rates in September, but what happens the rest of the year and into next year?
Yeah, absolutely. And, our view is still that even though it's a more slow, drawn out process as these tariffs are being passed through, that they will kind of pass through, overall, and then be temporary in the sense that it is a one-off rise in the price level, even if it's not happening over 1 month. And then inflation should moderate again after that. But the longer this goes on and maybe the more drawn out the process is, to your point, I think there's a higher risk that maybe it starts to bleed into inflation expectations. And then you could get what feels like a more permanent or longer inflationary process. Our base case is that's not likely to happen, but I think that is a material risk that this one-off boost to inflation, the more extended it gets, will spread into expectations and cause more of a problem for the Fed and the economy. Now, bringing that to the Fed quickly, I think they'll cut in September and then likely cut again one more time this year, in my view, probably in December, and then see the lay of the land next year in terms of how these effects are playing through. I do think at the end of the day, they'll focus more on the growth side of their mandate. So if the economy does weaken as we expect, I think they'll feel comfortable putting through those rate cuts. But, they're watching these things closely, inflation expectations, the breadth of inflation gains. If those start to become more worrying and they start to think that this could be a longer boost to inflation, then you're going to get less rate cuts at the end of the day. So I still see a lot of rate cuts coming, but it depends, of course, on how well inflation has behaved at the end of the day.
And Robert, what is the risk that if President Trump is successful in removing Lisa Cook from the Fed, and depending on who he appoints as the next head of the central bank, what is the risk is that the Fed will err too far on the side of cutting, even if there are those inflationary signs?
Yeah, absolutely. We are seeing a lot of changes to the Fed, both now in terms of personnel potentially, but also next year, as you mentioned, where Chair Powell's term as Fed chair comes to a close. I think what we are seeing is the administration is trying to move the composition of the Fed in a more dovish direction. And as we've been discussing, there are very valid reasons to think that rates should be cut in this environment. That's our base case as well, that the Fed will cut in this environment. And then the question becomes, well, what happens when we have that new composition going forward? And I think the most likely scenario is that the Fed remains independent, but with a more dovish composition as you get to marginal decisions on what to do with rates, where it's not so clear cut if you should be on hold or cutting or raising rates. Those are going to lean in a more dovish direction. So net, it probably means slightly lower rates than you would have otherwise. But I still think at the end of the day, the Fed is going to be committed to its dual mandate of stable inflation and a stable growth in labor market. But with that change in composition, as decisions become more marginal or closer calls, those will lean probably in a slightly more dovish direction.
Robert, thank you so much. We shall see, and we'll see what that jobs report shows on Friday. Appreciate it.
Thank you.
Congress is back in D.C. in session and soon will be attempting to avert a government shutdown. We'll assess its chances of doing so next. You're watching Market Catalysts. Congressional leaders returned to the Hill after a month off, and they're facing a pretty full schedule for September, from looming budget talks to confirmation hearings, new bills. Yahoo Finance Washington correspondent Ben Worschel joined us now with the key catalysts to watch this month. Hi, Ben.
Hey, morning, Julie. So there is a long to-do list for lawmakers as they come back to Washington this year. Two issues in particular I'm looking at. The first one you mentioned is the government shutdown. This is a deadline that's perhaps the biggest issue for all of Congress in the weeks ahead, and I think investors will be watching as well, which is an October 1st deadline in which the government will shut down unless Democrats and Republicans find some way to work together to pass an extension of government funding. For the moment, lawmakers are saying, especially Democrats are saying, that's not going to happen. This comes after Trump made a sort of surprise move last week to unilaterally cancel some previous government congressionally approved funding around foreign aid. The argument from Democrats is basically, why would we cooperate with Trump if he can just kind of cancel any spending down the road later? So we have kind of a standoff there. Chuck Schumer is the figure to watch there. He released a new letter this morning that focused on this rescissions issue, but also didn't explicitly promise a shutdown over it. So that's the back and forth there. Another kind of more under the radar issue that I think investors could be interested in is lawmaker stock trading. I've been covering this for years. We've seen lots and stops and starts on the issue of banning lawmakers from trading stocks, but there is going to be a new bill unveiled this week about banning it. It would reportedly give lawmakers 180 days to sell off their stocks, and is being sort of seen as the most realistic shot in a while we've seen on this. This was an issue that first rose to prominence during COVID when lawmakers were trading there, and we're seeing a new surge of it as at least some lawmakers are trading around tariffs. So that's going to be unveiled this week, and Speaker Johnson and Treasury Secretary Besson have also expressed support for the idea broadly of a ban. So that's another issue to watch there. But as you mentioned, it's a huge to-do list this week. The confirmation hearing for the new Trump's choice for the Federal Reserve, Stephen Moran, is also this week, as well as a whole lot of others. That's going to be a busy few days for lawmakers for certain.
For lawmakers and for you, Ben. Thanks so much for giving us a little preview. Appreciate it. Well, let's continue the conversation now around looming budget talks and that potential government shutdown. Joining us now, Douglas Holtz-Eakin, American Action Forum president and former director of the Congressional Budget Office, and Terry Haynes, Pangea Policy founder. Gentlemen, thanks for being here. Appreciate it. Doug, let's start with you. We were just talking about the prospects of a government shutdown here. We have this conversation on the regular, obviously. What are the prospects this time, and sort of how do you see it playing out in terms of how long it could last, what the crux of the argument's going to be over, et cetera?
Well, I think there's a serious chance of a shutdown, and the reason is that the House and the Senate are way behind schedule, so there's very little time. They're going to have to come to some sort of deal to get a short-term extension of continuing funding or something. The key to a deal usually is to have the White House brokering that deal. And it doesn't appear to my eye that the White House cares a lot about avoiding a shutdown. Number one, they did cancel the $5 billion in foreign aid, the so-called pocket rescission, which many lawmakers feel is, if not an affront to their prerogatives, illegal. And so that's stirred the waters. Had they been worried about getting a deal, they wouldn't have done that. They also called recently for a, quote, clean CR, just extending what we have. That's unpalatable to the Senate Republicans in particular, which it would continue essentially levels of funding dictated by President Biden. And so the White House is not doing anything on the surface, at least, to get a deal between the House and Senate, and they're pretty far apart in their funding levels and composition. So I think we could get a shutdown. Now, what are the stakes there? Well, number one, we've seen in the past that the economics are not dramatic. There's usually a shift of some economic activity until after the government restarts. That usually lasts, say, a week or something like that. And I think that's probably what we're looking at. The bigger stakes are who gets the blame and what does that do to the midterms? Because that would affect the composition of the political power and the ability to check the White House. And that's really what this is going to be about.
Terry, I want to get your take on that last part. Well, first of all, tell us whether you think there's going to be a shutdown. I think you do. And secondly, who is going to get blamed? It doesn't matter. And if the White House is not sort of, throwing its weight around, as we have seen it is more than willing to do, does that mean it's taking that gamble that the American public is not going to blame President Trump if a shutdown happens?
Well, good morning to you both. A couple of things. One is Doug laid the kind of the basics out very, very well in terms of what's about to happen. I'm the guilty party in saying that I think a shutdown's almost certain. I think the reason why is pretty simple. Democrats feel politically that they have to make some huge political show of Trump resistance, and they really couldn't do that during the One Big Beautiful Bill because of the way that the bill goes through Congress. But they can do that now, so they will, and they'll try to maximize. The president's inclined, as Doug says, to want to take up that fight, not only because he wants to have as much political power as possible to cut things, but also because he wants to show markets that he's the one that's interested in debt and deficit responsibility, and the Democrats aren't, which helps him politically as well as substantively. And I saw a lot of reporting this morning about bond markets squirrely about whether or not tariffs are going to remain intact or not. Well, I think tariffs almost certainly remain. So I don't think bond markets have to worry about that. But bond markets are going to get spooked by shutdowns and continued wrangling over spending, unlike in many past years, precisely because they've been so jittery about the large debt and deficit. You take that with the backdrop of what's going on in Britain and France today, it becomes even more acute.
Okay, so put all that together then for us, Terry, in terms of how it plays out, and is the American public and the bond market, for that matter, so accustomed to these shutdowns that the effect might be more muted?
Well, the public and the markets have, for a decade or more now, have been very used to this and think of it as political kabuki theater and brush it right off. Everybody, caterwauls about this in Washington. Doesn't matter to markets. My suggestion is it might matter to markets this time a lot more because we're already seeing, we've seen all spring and all summer into the fall now, concerns about the trajectory of debt and deficit in the U.S. and other developed countries. Well, the markets have largely shrugged off concerns with the U.S., but they're now starting to get jitterier about what's going on in the U.K. and France. My suggestion is that might well follow in October if there is a prolonged either government shutdown or wrangling over spending, because it will give evidence that the United States itself is not serious about this either.
And Doug, let's talk about tariffs for just a moment more, because we do have this legal challenge. As Terry says, he doesn't think it's likely to prevent tariffs from remaining in place. Certainly the sectoral tariffs aren't even affected by this court case. So how are you thinking about the tariff trajectory here and its effect economically?
Well, I think if the courts strike down the IEPA, the International Economic Powers Act, then the Trump administration will replicate their impact some other way. They'll use other authorities to put in place tariffs. So I think you should simply accept the reality that the president has been advocating for tariffs for 40 years, and he's going to put tariffs in place. He believes they're a good idea. So I think that it's interesting that they may not even appeal the decision to the Supreme Court, because to have the Supreme Court take that out of their hands is a more profound loss for the president. So we'll see what plays out. But I think tariffs will be in place. The sectoral tariffs are there. They're going to be more. They can do Section 301 tariffs against other countries on other issues. And so I think the level of tariffs, the president's indicated this is the level he wants, and how he gets there, I think, is the only question.
And Terry, I also want to ask you about the meeting that happened this weekend between Xi, Putin, and Modi, as well as other leaders gathering in China. That happening at the same time that today we learn the U.S. has taken away Taiwan Semiconductor's authorization to ship essential gear to its chip-making operations in China. So obviously there's all of this backdrop. What does this mean for a U.S.-China deal getting done?
Well, I think it's much, much less likely that any kind of serious U.S.-China deal gets done, and I've been saying that for a couple of months, even before the recent events. You had the China-Russia gas deal today. That shouldn't be a surprise to anybody, but it shouldn't be a surprise because it underscores that Russia's not Soviet Union redland of the 20th century. It's basically a Chinese client state and beholden to China. And what markets can read out of that, as well as the other meetings and the like, is that China's not interested in helping the United States resolve hot conflicts in Ukraine and the Middle East, and is not very interested at all in trying to reach some rapprochement on trade with the United States. NVIDIA got rope-a-doped essentially on this, and in part to make that point, and that's going to continue for a while. So I find this all to be markets negative for U.S.-China trade, as well as a broader geopolitical markets negative.
All right, gentlemen, always great to catch up with you. Appreciate it. Doug, Terry, have a great one.
And you.
Thank you.
Coming up, some of this morning's trending tickers, plus what to watch in Broadcom earnings later this week. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We are live at the NASDAQ. Let's get a quick check on the latest market action. We're about 1 hour into today's trading session, and typically September is a very volatile month. We're seeing a kickoff with all three major indices moving lower this morning. The NASDAQ leading that downward momentum here, down just ever so slightly more than the S&P 500. The NASDAQ down about 1.09%. That's followed by the S&P 500 down nearly 1%, and the Dow also down about 0.8%. And really what we're hearing from different sources this morning is that UBS out with a note this morning saying that the S&P 500 September is typically its worst performing month. It's declined in September in 6 of the past 10 years. And so we're seeing that momentum move lower, but also we're seeing investors move into some safe havens. Gold, for example, gold futures, those are moving higher this morning. We saw gold surge above that key $3,500 an ounce mark this morning. That eclipses that April all-time high that we saw earlier this year as investors really seek out safe havens. Also, what we're seeing is really this dynamic of sustained demand, as well as this macro uncertainty really fuel the demand that we're seeing for gold. We are getting some calls on the street that by Q1 of 2026, we could see gold surge above that key 5,000 mark. And on the flip side here, as investors take on that risk-off investment strategy this morning, heading into, once again, what is typically a very volatile month, we are seeing NVIDIA also fall lower this morning. Of course, NVIDIA has really boosted momentum behind this key AI trade that we've seen over the course of this past summer. That stock is down about 2% this morning, but we are getting calls on the street that long-term AI trend remains intact. But of course, investors are trying to assess some key things here, include that Federal Appeals Court ruling on Friday afternoon that most of Trump's global tariffs were illegal. We are hearing from headlines this morning that Secretary Besson saying that they do have a backup plan should that ruling go into effect. We also have the key jobs report out this Friday, and also the potential rate cut from the Federal Reserve happening in just a few weeks. And so as investors try to digest all these headlines, we are seeing, once again, all three major indices in the red to kick off this month's trading. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Let's get to some more of today's trending tickers. We are watching NIO, Signet Jewelers, and Amgen. First up is NIO, the Chinese electric vehicle maker, reporting a miss on revenue and deliveries for its second quarter. Looking ahead, third quarter guidance for revenue and deliveries also falling short of Wall Street expectations. This coming amid intense competition in the EV market. Next up is Signet Jewelers, the company reporting better than expected earnings and same-store sales in the second quarter. Adjusted operating income also grew more than 20%. Signet highlighting that second quarter results were driven in part by effective promotion and pricing strategies. Reflecting those second quarter results, expectations for the third quarter, and current tariff landscape, Signet is raising its fiscal 2026 guidance. And we're watching Amgen as well. That company jumping in on the string of new U.S. investments by the pharmaceutical industry. It's planning to spend more than $600 million to build a new research and development facility near its headquarters in Thousand Oaks, California. The building will feature advanced automation and digital capabilities. Construction expected to begin in the third quarter this year and create hundreds of U.S. jobs. Those shares little changed. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, shares of Broadcom lower with the rest of tech this morning ahead of the chipmaker's upcoming third quarter earnings. They're scheduled for Thursday after the bell. This comes as the NASDAQ 100 rallied for its fifth straight month in August, its longest winning streak since March of 2024. Paul Meeks, Freedom Capital Markets Managing Director, joining me now. And Paul, before we get to Broadcom specifically, let's talk about tech more broadly here, because we do have this sell-off today after that winning streak that we've been seeing for tech. We've seen some rockiness sort of creep into the equation here over the past month or so. Sort of big picture, how are you thinking about the group?
Well, the downdraft in the tech stocks actually started last week and it continues. And of course, we know, as you just mentioned in the lead-in, that September is typically a pretty grisly month for stocks, and particularly in this really confusing geopolitical backdrop, I would expect more of the same. So bottom line, Julie, is if you are a tech investor or an aspiring tech investor, there is no rush to buy any of these names, even your favorites, probably over the next weeks, maybe even over the next couple of months.
And what do you think are going to be the big sort of negative pressures on them? Or is it mostly sentiment-based here?
It's definitely sentiment-based, but there's going to continue to be until we finally have a deal done. As we know, the deadline has been pushed back and pushed back and pushed back. But I'm talking about the big comprehensive deal between China and the U.S. pertaining to tariffs, and probably even more importantly for tech, to export controls, particularly for the AI GPUs from the likes of AMD and NVIDIA. You know, those companies are representing the key theme driving the tech sector. And of course, the tech sector with its overweighted names drive the overall market. And so it is super important. And we'll have to see what happens in the end. But every time we seem to get closer to the finish line, it just keeps getting pushed away.
And we just had a DC policy analyst on who talked about the meetings this weekend in China between President Xi and Putin and Modi, maybe making things even less likely that there would be some sort of agreement. This morning, we've got the U.S. pulling TSMC, Taiwan Semiconductor's ability to ship components that it needs into China to make its chips. So all of that going on. Last week, Paul, I talked to Jensen Huang of NVIDIA after the earnings, and we talked about why the China market is still so important for the company. This is what he said.
It would be great for China, and we have an opportunity to go capture some of that $50 billion that is growing at about 50% every year. The second largest AI and computing market in the world. America should be part of that. It's great for exports. It's great for our treasury. It's great for American technology leadership. And it enables us to leverage that leadership all around the world.
So in other words, Paul, here's a company that obviously is growing handily without China, but Jensen says we still need to be there. And so to your point about the China deal sort of hanging over everybody's heads, is that what's needed in order for tech stocks to sort of get their groove back?
Well, I think a comprehensive deal is very much needed. And I expect what happens here, Julie, is not only settling or coming to some kind of at least stalemate on tariffs, that we will address the AI GPU export controls. We'll probably also figure out where does the U.S. operations of TikTok end up residing. And so a lot is on this, and it's a very important catalyst. And even if NVIDIA in the short term has so much demand from other regions that it can get by without these China revenues, over the long term, they and the rest of these companies in the supply chain must be in the China market. They absolutely must. This is a situation, believe it or not, at least in my opinion, I believe that we need them much more than they need us.
Paul, I do want to turn to Broadcom and getting those numbers after the close on Thursday. You know, this has been, for many investors, the sort of NVIDIA alternative, or at least addition, right? And so what do you think we're going to hear from them? And is that going to be a potential reason for people to get in here?
Another great question. So first of all, even though I'm confident with what Broadcom will say and do on Thursday night, the really nasty, particularly the guidance from Marvell last week, makes me incrementally concerned about Broadcom, even though Broadcom versus Marvell, Broadcom's a much better managed company. Broadcom not only has these custom chips that they're designing for the hyperscalers, but they also sell a big market of components into data networking. And then, of course, also Broadcom is a hybrid. It's part semiconductor company, it's part software company. But we will get a tell. Hock Tan, their CEO, just like Jensen Huang over at NVIDIA, is very carefully followed with his comments, not only as a barometer for his company's success, but the broader industry. And so it'll be a pretty important tell, particularly after Marvell scared some folks last week.
Paul, we'll see what they say. Good to catch up with you as always. Thank you.
Best wishes.
Coming up, ways to play furniture stocks as President Trump pushes for more companies to manufacture in the U.S.
Furniture stocks under pressure as President Trump threatens new tariffs on furniture imports. We're navigating how to play the sector with the Yahoo Finance playbook. Joining me now is Michael Lasser, U.S. hardline and broadline and food retail analyst at UBS. Michael, thanks so much for joining us. President Trump is threatening new tariff imports on furniture. Are tariffs finally going to be the catalyst that brings furniture manufacturing back to the U.S.? And what does this really mean for companies in your coverage universe?
So what it means for the companies in this universe, including Wayfair, RH, Williams-Sonoma, and others, is that the environment remains very uncertain and very dynamic. It's difficult to plan, manage, and organize when there's so much uncertainty out there. And the rules of the game constantly are changing. So whether or not there is more furniture manufacturing brought back to the U.S. remains to be seen. Obviously, if there's a significant tariff that's implemented, it will make it more economically feasible to do more of that manufacturing in the U.S. But for now, it remains to be seen.
And let's talk about some of the names that you cover in this space. You have a buy rating on Wayfair. And what makes you so bullish on this stock? How much pricing power does Wayfair have to pass on cost? And will the momentum hold if the tariffs force price hikes?
So remember, Wayfair is a marketplace model where it connects sellers of home-related products to buyers of home-related products. The sellers of those goods are the ones who really set the price with some perspective from Wayfair. But if there are a certain set of sellers on that marketplace that are raising prices, buyers can go seek out lower cost alternatives on that marketplace. So in our view, this is a model that has more flexibility to navigate through the tariffs than others who have either a vertically integrated or a design-oriented model that may have less pricing power.
And it's a very competitive space when you're shopping for furniture. Let's talk for a second about another name that you cover, also RH. You mentioned that by the end of the year, about 52% of its upholstered furniture will be produced here in the U.S. Does that reshoring theme bode well for RH given that trend?
I think there's going to be a balance between what home furnishings retailers and manufacturers can produce in the United States and in other markets. These companies are very sophisticated. They're very smart. They're going to go to wherever it costs the least to produce the goods. You yourself said that this is a very competitive industry, and that's absolutely right. The consumer's smart, astute, and willing to shop around to get a good deal. So that puts the burden on these manufacturers as well as retailers to ensure that they're offering the highest quality goods at the lowest prices.
And Williams-Sonoma, that's another name that you also cover. You have a neutral on that stock. What's the story with Williams-Sonoma?
Williams-Sonoma is doing a really good job. They're doing a good job of being early to trends. For example, Williams-Sonoma started to serve the business-to-business market before a lot of other retailers began to look at that segment. Similarly, it has really captured the dorm room trend. I don't know if you're familiar with this, but there is an emerging trend as college students move into their dorms to really bling out their dorm. And Williams-Sonoma, through its Pottery Barn, West Elm, and other divisions, has benefited greatly from that. So it's been quite astute in how it's been navigating through it. And the only thing that really keeps us holding back is it trades at a pretty good multiple at this point.
How times have changed. When I went to college, it was just you get the bed that's there and the dresser that's there, and it looks like it's an old piece of furniture. But anyways, look, a lot of companies have shifted manufacturing out of China, and we've heard this over and over again. But they've also shifted some of the manufacturing to not just North America, but a lot of them to other Asian countries. And there are tariffs on other countries. So, I mean, are they really able to dodge tariffs if they're going from place to place, yet you still have the U.S. with tariffs on some of these countries?
These companies are using all of the tools and levers at their disposal to try and navigate through the tariffs. That includes moving domicile of production, changing and re-engineering the products to make them lower cost, and when in doubt, using price as a tool to try and offset the cost. Remember, these companies have a fiduciary responsibility to maximize the value for shareholders, and they're not in the business of just assuming exogenous costs. So they're going to look to try and navigate through it any way they can.
Thank you, Michael.
Thank you.
Manufacturing contracted for a sixth straight month in August, according to the Institute for Supply Management. It did rise slightly from July. The ISM's manufacturing index for August at 48.7 compared with July's reading of 48. Joining me now is Susan Spence, ISM Manufacturing Business Survey Committee Chair. Thanks so much for joining us. I know you're relatively new in the role. It's great to have you here, and you've a veteran of a number of different manufacturing companies, so it's great to have your perspective on this. So a little bit better, but still not great, Susan. Is that how you would categorize? What's the sort of vibe out there among your constituents?
Thanks, Julie. I'm really happy to be here. Little bit better is right. I consider a 0.7 uptick encouraging, but kind of flat. And more importantly, let's look at the sub-indexes. And I'll talk about the vibe certainly in a moment. The new order index did leap into expansion category, first time in a long time, 51.4. However, that increase was almost evaporated by the drop in production. So when we think about demand, new orders, new export orders, customer inventory backlog, for us to get excited, we would want to see these all moving in concert together, and they're just not. The panelists, 89% of our panelists continue to cite tariffs and the uncertainty and the whiplash as the thing that is holding things back. So I would feel much better if we saw indices moving more than just one. A few months ago, production was up. It's back down. It's lost that ground. Customer inventories have been low for a while, so my gut's telling me this is a reorder point. But until we have solid economic policies that people don't believe are going to change within weeks, we're going to be in it for a while. The other thing that stuck out, prices 11 months in a row are going up a little slower, but they're going up. And if you look at the manufacturing GDP, 69% of it is in contraction. It's slightly better than last month when it was 79%, but that is not good. Employment continues to, not be in a good space as well. And these panelists specifically, for every panelist that talked about hiring, there were 4 that say no, we're not backfilling. We're laying off, in some cases, closing factories. So we really need to see order flow first and foremost. I don't believe that's going to happen until folks know what's going to happen to their prices. And these manufacturers, when they're talking about a 15, 20, 35% tariff, how are they going to keep their profit margin? Your last guest talked about a fiduciary responsibility, of course. So that's not 3% that you can absorb or split the difference with the customer.
Susan, I want to call out in particular a comment from a trucking equipment or a transportation equipment company in the report. First of all, the person compares it to the Great Recession of 2008, 2009, saying the current environment is much worse. Right. They say there is absolutely no activity in the transportation equipment industry, and this is 100% attributable to current tariff policy and the uncertainty it's created. They also are calling out stagflation, that prices are up. How widespread is that kind of sentiment in different subsectors of the manufacturing industry?
It does depend on the industry. That comment is there for a reason. It was very stark. I worked for the last 10 years for FedEx in transportation, and just like we say, the manufacturing ISM report sees things 6 to 7 months ahead of the rest of the economy. Transportation sector is leading indicator, right? And, you also have some of the commodities that are, continue to be up, affecting these guys. That's about as bad as it gets. And they're one of the big six. So what I think about is, what is happening to pass through prices to the consumer? And if you're in a family where perhaps, you're having a hard time finding a job or keeping a job because people just aren't hiring because they aren't sure what's going to happen with their companies and their profit margin because where's their input costs going? It's kind of circular. And it is scary. So the panelists are clear. They need to have a set economic policy. They have to understand what it's going to be and then believe it's not going to keep changing. And they're just not getting that right now.
Well, and isn't the irony here is that these policies, one of the stated purposes of the policies is to help domestic manufacturing, Susan. So yes. What do your members need from this administration to actually help them?
Number one, they need a deal. They need a deal that's not going to change. Obviously, deals that increase input costs from a 30% tariffs aren't great either. But I hear more comments about the uncertainty, and then of course, and not secondary is how much is that tariff increase? So if their customers aren't ordering, like in the trucking, the transportation equipment industry, if their clients aren't ordering because they don't want to pay those high prices or they're holding off, that's not going to change until what happens? Certainty. When everything's whipping around, changing, and your input costs are going up, if you can, you're going to just sit still and you're not going to do anything, right? It's a little like the consumer, right? If you've got your basic ingredients that you need to buy, right? Eggs, milk, sugar. But there's things that you would normally have no issue with buying. And if your prices are up 30%, you're just not going to do it. So they need certainty, they need policies, and they need to believe it won't change. And that last thing is really, really hard, especially now.
And just briefly, Susan, to go back to something you said, that these sectors tend to be leading indicators, transportation in particular. So if all of that doesn't change, do you see us being led into a recession?
I see it going that way for sure. Thankfully, it was a pretty strong economy in January. How long before that gets undone? And I never say permanently. Business people don't like that uncertainty. I know I'm a broken record here, but they need to know what's going to happen, and the whiplash and the whipsawing is not good.
Susan, really appreciate your perspective and time today. Thank you.
Thank you, Julie. Bye.
Bye. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. on Market Catalyst. First up, the EV tax credit expiration is looming. What that means for the industry as consumers look to take advantage. Plus, the top AI software stocks to watch ahead of Salesforce earnings this week. And using artificial intelligence for market analysis, the role the tech could play in the years ahead. It's 90 minutes into the start of U.S. trading. I'm Julie Hyman, and let's get a check of the markets here. We've been seeing a sell-off this morning, kind of wax and wane. Now we're near the lows of this early session here. The Nasdaq leading losses as we've seen tech continuing to lead the sell-off here. The Nasdaq down 1.3%, the S&P 500 down 1.1%, and the Dow down about 374 points or so, about 0.8%. Well, the federal tax credit for electric vehicle purchases, it's set to expire at the end of the month. That has EV makers scrambling to offer deals to attract consumers while they still have that incentive. Joining me now is Carl Brower, iSeeCars.com executive analyst. Carl, it seems like these deals are out there while the incentives are in place. How is this playing out on lots around the country?
Well, we're definitely seeing that pull forward effect, which is the term in the industry we use when everyone knows something's going to change, and people who might have been on the fence or thinking of a purchase in the next 6 months decide to make one in the next few weeks because of that change. So I think you're going to see third quarter EV sales probably go up slightly, or at least remain strong, simply because people who want to buy one are going to jump in before that September 30th deadline. But I think then after that, we're going to see a pretty big drop off. I could see us, especially because of that pull forward effect, it has the opposite effect when those things do change. And I could see us dropping well below 4% immediately after the September 30th incentive goes away, and maybe settling in the beginning of 26 around 4%.
If the inventory doesn't move to the extent that the automakers want it to move, though, are we going to continue to see promotions and price cuts even after the incentives expire?
We probably will. There will probably be additional efforts to move the vehicles, even with the incentives gone. You may remember a couple of years ago when General Motors ran out of the $7,500 credit because they'd reached the cap on how many they could sell for that. They simply lowered the price of cars like the Bolt, the all-electric Bolt, by $7,500. So we'll see if there are similar price reductions after the incentive goes away.
And what does this suggest, Carl, about underlying demand for EVs, right? If you look at what consumers are prioritizing when they're going car shopping, is price always number one? Or, how do people think about those decisions?
For people who are more affluent, price can be a secondary concern. And not surprisingly, those are a lot of the people who buy EVs. But certainly, mainstream buyers, price is number one. And I think, even before, again, the incentives go away, we saw the new car market share peak around 8% for electric vehicles. And people were thinking it was going to just keep accelerating. We'd be hitting, 20% by next year and easily 40 or 50% by 2030. And, at IC Cars, we were studying individual markets for years, and we watched how markets that were kind of ahead of the game on EV transitions, when they got to about 7 or 8%, the growth rate slowed dramatically. So I believe under the current circumstances with the credits and all, there's like an organic kind of tipping point at about 8% where demand starts to really slow down because mainstream consumers still see a lot of limitations with EVs. And without the incentives, plus don't forget the manufacturers aren't going to have incentive to build the cars. There's every indication that regulations and penalties if you don't sell enough electric vehicles are also going away. So there's neither a carrot nor a stick to sell these vehicles. And I just think, consumers are still very worried about things like infrastructure, temperature. If you live in a colder climate, you lose 30, 40% of your range. It takes much longer to charge. There's still a lot of restrictions with electric vehicles, and a lot of consumers recognize that, and they're just not willing to take the chance or try one out yet.
So, Carl, if we zoom out and look at the car market overall, we're going to be getting some of the monthly sales figures in the next few days from the major automakers. It's not as though you're looking at a robust overall car buying market, even ex-EVs, right?
That's exactly right. Yeah. I mean, I think, it's interesting. I was watching your former guest, and, I feel like there's kind of been a teetering right now. We're not definitely sliding into recession, but it does not feel like there's this robust confidence in economic circumstances. And I think that's limiting consumer willingness to commit to large purchases. And car companies have been slowly kind of moderating their prices. We're finally getting back to like MSRP or even, below MSRP, which is where most cars sold for most of the history of the automobile. But since the COVID constriction, they've been priced way high. So it feels like we're at a tipping point for regular cars, as you're saying. And the fact that we've got EVs, which have even bigger challenges to sell, and we're losing those incentives and losing those regulatory requirements, they're going to drop. They're going to drop to around 4% or less after everything settles out.
So, Carl, are there any automakers where they are really sort of retaining that demand? Are we seeing, you mentioned, of course, on the higher end, maybe people are faring a little bit better. Maybe on the lower end, you're seeing the cheapest cars still move. Is it the middle that's the most challenged in terms of price point, or are there certain makes that people feel are still a good value?
It seems like all of them are really struggling. I don't think there's anyone that's going to be protected from this. Tesla's still, of course, the biggest seller in this country, but for various reasons that a lot of us know about, he's facing reduced volume and reduced revenue. I think he realizes he's got to get self-driving going because that business model of selling electric vehicles that keeps growing isn't going to do that anymore. But, you look at pure EV makers like Lucid or Rivian, who that's all they're selling beyond Tesla, of course. And I feel like Rivian may get just closer to Volkswagen because they're already working together and they may need to. Lucid's got a big investment company in the Middle East that's funding them, so they may be willing to keep dumping money in. But the idea that any of these pure EV makers are going to grow versus contract over the next 1, 2, 3 years, I think that's impossible. I don't see how any of them grow in the next couple of years.
And then, Carl, there has been a trend of hybrids picking up some of the slack, right? And automakers making more of them. They're proving a bit more popular again. Do you see that trend continuing?
Absolutely. We've got the all-new Toyota RAV4 coming soon, 2026, and it's going to be nothing but a hybrid. And it's the best-selling vehicle in this country. Same thing with the last redesign of the Toyota Camry. So mainstream cars absorbing or adopting hybrid technology, I kind of equate it to fuel injection. Once upon a time, that was an advanced technology for high-end race cars and performance cars. Now you wouldn't build a new car without fuel injection. I think that's going to happen to hybrid technology. It'll just become very dominant because why would you waste all that energy when you're slowing down and stopping, just making heat? Why not recapture that and help you get going again, which is essentially what hybrid technology does.
Interesting stuff, Carl. Thank you so much. Appreciate it.
Thank you.
Coming up, we're going to get an analyst take on the top AI software stocks to hold. That's next on Market Catalysts. Software stocks got a boost last week on positive earnings reports touting AI growth. While AI is currently a boon, could it also be a key risk to some of these companies? The Autodesk CEO saying on the company's earnings call, quote, AI may eat software, but it's not going to eat Autodesk. Joining me now is Steve Koenig, Macquarie Head of U.S. Technology Research. Steve, it's good to see you. So this has been a little bit in tension and a little bit sort of debated over the past couple of years, the relationship between AI and software companies. How do you think about it, and which ones may do better in this kind of environment?
Great. Thanks so much for having me on the show. I think there's actually a ton of overlap now between AI and software. And one way to think about it is that virtually every private company that's getting VC funding nowadays has an AI angle. So interestingly enough, though, if you look at the top AI native companies that originated as being AI focused, and we've compiled a list of the 58 top AI disruptors, we call it. That list is entirely private companies. There really are no public software companies of significance that originated as AI companies. And as you noted, we're seeing increasing competition between those AI native companies and the public software companies. And in particular, the large SaaS companies are working very hard to try to protect their application domains from incursions from AI natives. And so you're seeing increasing competition there happen.
Steve, I just want to put a fine point on this because I think it's really interesting. So your distinction between AI native companies, those that began as AI companies, and those that have sort of bolted it on in various ways. What are some examples of when they are going sort of head to head here, those publicly traded software companies and the privately held AI companies? In other words, what exactly is being replaced? What are some examples of that?
Great. Yeah, thanks. That's a great question. And there are, the very largest AI native companies on our list are the model companies. So your OpenAI is responsible for, roughly almost half the valuation of the total list of private AI companies, and you've got Anthropic in there as well. And those companies, OpenAI is both a partner and somewhat at odds with Microsoft as well. And potentially there's more competition in the future. I think you're seeing in terms of some of the use cases that are really getting traction from the privates that do compete with the public companies. One company of note is Anysphere with its product Cursor is a coding assistant. It automatically generates code, does this vibe coding. And this sort of coding, automatic generation of code is something that Microsoft does, for example, and Microsoft wants to capture that market. But Cursor's making significant inroads in a lot of large enterprises. So that's a great example. A smaller example of something that I think we'll see more in the future is a company called Sierra. And Sierra is one of a class of AI natives that focus on agentic AI. And this is the use of agents that can function almost as human beings do. And they can either function with human assistance or they can function autonomously. And Sierra is ultimately, their strategy is to build a customer service agent that can handle customer service inquiries and take actions in enterprise systems. And that is something that, and that's the first part of their strategy. I think over time they'll broaden that out to cover other use cases, but that will directly challenge Salesforce.com and their Agentforce product. And that's something else you're seeing from these large public SaaS companies. They are almost all of them are adopting an agentic AI strategy to create agents that their customers can use to do things autonomously in their systems. And I think although Sierra looks promising, Sierra and other companies like it will be challenged to make inroads. The SaaS companies have an upper hand in the fact that they manage the customer data. They can control that data. They can make it hard for these AI natives to access that data, as we're seeing some of that happen recently. And they can integrate these agents with their application workflows. So it's going to be a while in coming, before we see that significant inroads being made by the AI privates, but you're still seeing some of these AI natives with their models, and then broadening those strategies from the large AI natives to be entire platforms. I think we're going to see more of that, and ultimately those platforms will be a significant force in software, we believe.
So in the meantime, Steve, as an investor, what do you most investors don't have access to those private companies. So among the publics, should people be buying something like Salesforce as it gets into agentic? How are you gaming out the odds of which software companies are going to be successful with agentic or whatever other AI features that they're putting forward?
Yeah, it's a great question. And all of the companies we cover have some AI angle. It's going to take a while before monetization from the AI strategies by the public companies can really move the needle on their revenues. But I think, investors investors are looking hard to try to figure out who are going to be the AI winners and who are going to be the AI losers among the public companies, who benefits and on net, and who's going to have more of a challenge on net. And I think that can influence stock prices as well. And right now, I think there is some degree of skepticism about how quickly Salesforce's AI strategy can benefit them. But on the other hand, a company such as Autodesk, which is not really, it hasn't really gone public in a big way with its AI announcements. They can do some very interesting things with AI. And what Autodesk focuses on from a core product perspective is essential design tools for architects, for engineers, for product designers. And these design tools are standards in their industry: architecture, engineering, construction, and manufacturing. And Autodesk has an opportunity to use AI to help engineers, help product designers and architects start with an idea, and from this idea, create whole designs and have the AI help with that design process to not only create the ideas, but put them into a 3D model, for example. And I think we're going to be hearing a lot more from Autodesk around September 16th, 17th. They have their annual conference, the Autodesk University. And I think we're going to be hearing a lot more about their AI strategy. That'll be pretty exciting.
Interesting. So it sounds like you agree with the CEO then that AI is not going to eat Autodesk. But before September 16th in that conference, of course, we're going to get Salesforce numbers after the close tomorrow. As you mentioned, there's a lot of skepticism. The stock is down 25% this year already. Do you think that tomorrow we're going to hear something that salvages that? Do you think people should be buying Salesforce going into those numbers?
Yeah, I think tomorrow with Salesforce, it's going to be all about the numbers. I think there's nothing that Mark Benioff can say about their AI strategy that's going to change investors' opinions, but it's really going to be about the numbers. And we're not trying to call this print for Salesforce into the quarter. If they can make the upper end of their guidance, that implies that there's going to be a positive inflection in their sequential revenue additions for their subscription revenue, and those sequential additions have actually been falling year on year for almost like 12 quarters for Salesforce. So that could be a positive sign if they can just make those numbers. It could help shore up some investor confidence. But ultimately, I think what investors, many of them are hoping that Salesforce can grow double digits again, and now they're in the high single digits, and there's a hope that AI can propel that. We think that's going to be a tough challenge to move the needle on, at least on organic growth at Salesforce, to get that back into double digits. We don't think in the near future AI is going to be doing that. Maybe a few years out, but not in the near future.
Interesting. Steve, thank you so much. It's good to see you.
Thank you. Take care now.
Coming up, we'll get another check on the markets and get a check on the tech sell-off that's been going on. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Broadcom. We're live at the NASDAQ. Let's get a quick check on the latest market action as we're kicking off. We're about 2 hours into today's trading session as we kick off the month of September, which typically is a very volatile month. As you can see here, the S&P 500, typically September is the worst performing month. It's declined in September in 6 of the past 10 years, and we're seeing that momentum continue into this morning as we see a bit of a sell-off for the S&P 500, down about 1.3%. The NASDAQ leading the downward momentum among all 3 major indices here, down about 1.6%. We'll dive into that in just a bit. And the Dow also down about 1%. And this is largely as investors try to assess the latest ruling from the Federal Appeals Court that Trump's tariffs might be deemed illegal. They are still in effect. We also have that key jobs report out this Friday. And in addition to that, we also have a potential rate cut happening in just a few weeks as the Federal Reserve is expected to meet. But let's dive into what exactly is moving this downward momentum for the NASDAQ. If you take a look here, we do have heavyweight tech also weighing on the stock here. NVIDIA down about 3% as we make our way into the week against that key earnings report that largely didn't budge investors too much off of this investment, or rather this leading AI revolution, this leading AI arms race story that we've been hearing. We also have Amazon moving lower, down about 2.5%, and Google leading that downward momentum here. And I also want to take a look at the AI trade, because this is what exactly has been leading the market rally that we've seen over the course of this summer. And now we're seeing some of those names move lower as we make our way into this new month of trading. Salesforce will be a key announcement out this week. It's up about 2.5% over the last 10 days, but now today seeing some downward momentum as we see this sales tech sell-off. Also keeping a look at Supermicro That stock under pressure, down nearly 4%, leading the downward momentum. And also Snowflake also seeing, we know that this stock has been, really seeing a bit of a rally over the past month, up about 12.5%, as we continue to see this really onward momentum around AI fueling the rally that we've seen over the summer. And now we're pulling back a bit. Once again, Google, Nvidia also seeing downward momentum and taking a step back. All three major indices in the red to kick off not only this trading session of the week, but also this momentum in September, which typically is a very volatile month. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching shares of Tesla, gold miners, and McDonald's. First up, a look at Tesla. Those shares have been under pressure in recent days following a 40% drop in European sales for the EV maker in July. CEO Elon Musk taking to social media to share his vision for Tesla in a post on X, saying he sees roughly 80% of Tesla's value coming from optimists to company's humanoid robots in the future. The shares are down another 1.5% today. Brooke De Palma is still with me. And Brooke, I mean, this is nothing new. He's been beating the drum on robots and optimists for a while. The question is whether investors have stopped believing it.
Right. Over the past year, we've seen such volatility in Tesla's stock as investors have had to not only digest the future growth potential of robots and robo-taxis, but also Elon Musk's role in the White House. And now investors are certainly trying to hone in on what exactly this latest, announcement from Elon Musk has said. We know that previously Musk has said that Optimus robots would someday turn Tesla into a $25 trillion company. We also know that Tesla has announced and tested those robo-taxis in Austin, Texas, and San Francisco. Of course, that test back in June from the robo-taxi in Austin got so much attention from Wall Street about what exactly this can mean as Tesla looks to compete with Google's Waymo, among others. But largely, the speculation is still there about when exactly we'll see the returns from these major investments. But certainly lots of potential news that could come out of this.
Sure, potential, maybe someday. We'll see. All right, next up, let's look at gold miners. Those stocks are getting a lift in today's trade as gold touches a record high. The price of the precious metal surging above $3,500 an ounce. It's bringing the gold miners along with it. They don't always move one-to-one, Brooke, but we are seeing them get a lift today.
Yeah, what we're seeing is McEwen Mining and Knights Group. We also see those stocks moving higher today. In addition, gold ETF, GLD, that is also moving higher as well. It's important to note that we've gotten so many calls on the street that gold could reach above 5,000. And that's really what we're seeing here is this momentum behind gold certainly take effect when you see, if you look at the YF Interactive, I finally got it up. We're seeing across the board, mostly gold miners really go in the green today. And that's largely because of this optimism about that potential gold hitting above the 5,000 mark when it comes to Q1 or by Q1 of 2026. And once again, you see these key companies really leading the trend here, including McEwen Mining. We also have Knights Gold also seeing some momentum here. But then I also do want to point out that it's not just individual stocks that are gaining momentum off of these gold rallying. We also have this ETF also moving higher, and you could see Gold Trust ETF has largely moved with the momentum that we've seen in gold year to date as investors, especially today, among so much uncertainty around, the Fed's meeting coming up, that jobs report, the uncertainty around tariffs. We've seen gold futures rally, and we've seen investors really seek out safe havens, especially to kick off this really volatile month.
Yeah, exactly. Maybe they're also seeking out some comfort food, Brooke. Let's talk about McDonald's. The company is expanding its value offerings starting on September 8th. The fast food giant is bringing back its extra value meals to try to tap into affordability for consumers. This is something we knew was coming. Now, here it is. It's imminent now, and this really speaks to the value proposition that a lot of these fast food and fast casual companies have really had to lean on lately.
Yeah, and lean in they did, and returns they saw. We saw U.S. same-store sales growth for McDonald's flip to the upside in the latest quarter, largely because of them slowly trying and executing to return to that value proposition. And now, not only did they have that $5 meal deal, they also had the buy one, get one for $1. And now this is the latest return or latest trajectory triumph of McDonald's trying to lean into value even more with this extra value meals that they're offering, including a $5 sausage McMuffin with eggs. We also know they're going to lean into an $8 Big Mac meal. And in the release this morning, McDonald's President Joe Erlinger saying the McDonald's USA is laser focused on delivering value and affordability for customers. Of course, we've seen from a slew of other QSR companies, quick service restaurants in the space also lean into value, including Taco Bell, Burger King, et cetera. And it's interesting to see, if you look at QSR today, we see two of the top value-oriented companies, including Domino's and McDonald's, in the green. They're the only ones in the green as they really double down on that intention. Domino's has the $6.99 meal, McDonald's, seeing some momentum today based upon this lean into extra value meals. But really, these are companies that were under pressure over the past year because of the fact that investors, or rather, we're seeing some momentum as investors feel like these companies had to really get back their value proposition. And so as they've leaned in even more, they've certainly seen a return. And that's what we're seeing with McDonald's, just a bit higher today. But this is important. This is what consumers really want now. We know that based upon if you get all the individual things as part of these extra value meals individually, you'll see about a 15% lower price tag in this so-called extra value meal, combo meal that McDonald's is really leaning into.
All right, we'll see what the uptake is. Thanks a lot, Brooke. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, consumer spending has been holding up even in the face of sticky inflation, but how much longer will shoppers be willing to dig deeper into their wallets? Let's bring in Mark Matthews, National Retail Federation Chief Economist and Executive Director of Research. Mark, thanks for being here. So you are watching for those telltale signs of inflation and whether people are going to be willing to pay for higher prices. What have you been seeing so far?
Well, firstly, thank you so much for having me. It's a pleasure to be here. Yeah, we're definitely seeing a concerned consumer, right? All we have to do is look at the sentiment data. Now, we have had some bump in sentiment in recent months, but the latest data, again, was relatively soft. And if you look at it from a historical standpoint, consumers are not feeling great. But it kind of reminds me of, what we saw in 21, 22 when inflation was really high and sentiment was really low. Consumers have continued to spend into their sentiment. They're spending the money that they have, but they are definitely being a lot more cautious with how they spend that money, right? So we're seeing, less spending in certain areas of the economy, especially in non-essentials, right? So people are willing to go out there and spend on essentials, spend on their family, but I think it's a little bit more challenging in other areas of the economy.
And where are we seeing those price increases from retailers? Because as we know, we have not seen, according to a lot of economists, according to your analysis, we've not seen the full impact of the tariffs show up in consumer prices.
Yeah, that's absolutely correct. We're seeing a lot of those tariffs being eaten so far. The Goldman Sachs research showed that only about 22% of those are being passed along to the consumer. I think there are product categories that we're seeing clear increases in, like coffee, for example, but not really broadly spread enough to see a real push into overall CPI data. So the consumer is definitely concerned about tariff inflation. We haven't really seen that come through yet, but the expectation is that, at some point that's going to begin to pass through. But consumers are already changing their behavior in advance of that. A lot of the retail sales that we've seen so far this year have been driven by consumers reacting to future events. We've seen big pull forwards of spending because consumers are worried about prices rising in the future.
And so, we've also been hearing from the retailers themselves, the individual retailers, and there too, it sort of backs up your thesis here. The value retailers have tended to do better by and large, right? So is that going to continue to be the theme here?
Yeah, I definitely think so. And we're also seeing somewhat of a bifurcation in consumer spending, right? So we're seeing lower income households be a lot more challenged. And higher income households have been growing as a larger and larger part of the economy. If we look back a couple of decades ago, higher income households only accounted for about 37 to 40% of total household expenditures. They're now over 50% of total household expenditures. So higher income households are less impacted, and they are driving more of the spending in the retail economy.
Mark, thanks so much. Appreciate it.
Absolutely. My pleasure. Thank you.
We got much more markets action coming up. You're watching Market Catalysts. Deal making this summer has been booming. Companies have announced over $1 trillion worth of transactions since the beginning of June, according to Bloomberg data. Rob Brown, CEO of Lincoln International, it's a global investment bank focused on mergers and acquisitions. He joined Market Domination Overtime to discuss what has been driving the rebound in M&A.
I think it's several factors. I think one, when you see a stock market that is at or close to an all-time high, you have companies that their investors are expecting growth, and they're going to have a hard time meeting those value expectations just with organic growth. So what that does is cause them to look for inorganic growth and look for acquisitions. And so I think that's factor number one. I think factor number two is there's a lot of liquidity. When you look at the private equity markets and you look at the private debt markets, there is a lot of money that wants to be put to work to buy companies. And I think the third thing you factor in there is the markets are shaking off Liberation Day. The public markets have clearly shook it off. I think you're starting to see the private markets shake it off. And we've had a bit of a slowdown. There's been a recalibration in the M&A market really since interest rates started to tick up. And I think we're getting to the end of that recalibration where buyers and sellers are finding ways to meet on value and terms.
And just the fact that we've been seeing the markets at all-time highs. You mentioned liquidity, and we've been seeing so many assets that are going up in value. I mean, is this a time where where you do see increased activity in M&A?
Yeah, I think so. And there's also has to be a catch-up, right? I mean, there was this, and you alluded to it, there was this incredible activity in 2021 and the first half of 2022, particularly in private equity of companies that were acquired. Well, now you're getting to the 5-year period of those where the debt maturities, all the debt raised on those is coming due. And so you have to do something. You have to sell that. You have to refinance that. So I think that maturity wall that's looming out there in the private equity world is also forcing activity. And I think the other thing we're seeing is, when the market first kind of turned down a bit, the M&A market, there was I'll sell this if I can get a great price. I'll go test the market and I'll see if I don't, I'll keep it. What we're seeing now is when sellers come to market, they are committed to selling at what the market will bear.
How significant has the regulatory environment been? Just the fact that you have less regulations, it's a little bit more eased in that sense.
I think when Trump won, there was a lot of excitement about that we're going to be in a lower regulatory environment and that's going to create a lot of activity. I think that's going to happen. I think there's optimism about that happening, which is helping the M&A market. Obviously, I think Liberation Day was a bit of a curveball for the M&A market. So I think there's been kind of puts and takes in policies, and clearly the anticipation of lower regulations, I think, is helping businesses feel optimism about the future in a more business-friendly environment.
And what are the sectors that are leading with this M&A activity? Which ones are the ones that are seeing the most action?
Yeah, so one thing I'll point to is technology. I think technology was really affected because valuations were so high at the peak of the market that when those came back, the recalibration was probably a little bit more painful there. We're seeing a material pickup in technology. We're seeing very good activity in services. The two areas of the economy that there may be a little bit more of a pause are the ones that not sure the tariffs are going to affect us yet, and that's consumer products with a lot of imports and also certain pockets of industrials. Although I will say on the industrial side, we're continuing to see good activity there because a lot of products are spec'd in and their ability to pass tariffs on to the ultimate consumers is better.
And about you mentioned consumer products as well. I mean, in the whole tariff situation, wouldn't you make a case though for companies that are struggling? Let's say if there are like increased costs. I mean, all companies have seen increased input costs. So wouldn't that also lend itself towards merging at some point?
Possibly. I think you could see consolidation out of necessity.
Yeah.
For sure. I think you could see that. But I think The concern right now, a bit as it relates to tariffs, is that they really haven't worked their way to the consumer yet, right? The importers and exporters are bearing some of the brunt, but eventually it's going to make its way to consumers. So I think that uncertainty of, hey, what's this really ultimately going to mean for the consumer is putting a bit of a damper on the consumer M&A market.
So what are we going to be seeing into this back half of the year, and if rate cuts come to fruition?
Yeah, well, I think rate cuts will help. There's an increased anticipation that those are going to happen, so that alone I think is going to help. If we look at our own backlog, and I'm sure other M&A advisors are seeing this too, there is a large number of deals that have been prepped and ready to go to market post-Labor Day. Well, post-Labor Day is next week,
Yeah.
so our anticipation is you're going to see a material pickup in new deals coming to market and deal closings in the third and fourth quarter.
And this is going to be led by, as you mentioned, tech and...
Yeah, I think it's going to be across all industries, but I think you're going to see more in tech, more in services, more in businesses that have good visibility and less exposure to tariffs.
And the AI theme, I mean, are we seeing also a lot of enthusiasm around that?
I think the AI theme is helping tech overall,
Yeah.
right? Everybody's trying to play their software product, their IT services product, as we're going to benefit from the tailwinds of technology. Another area we're seeing a lot of activity in that's tied to technology and tied to AI, but it's a little bit more on the industrial side, is anything tied to data centers. So anything tied to products or services going into data centers is one of the hottest areas in M&A right now, both on the strategic side and on the financial side.
Data centers is hot. Thank you so much, Rob. Thanks for joining us.
Thank you.
AI startup Reflexivity counts SoftBank and Greycroft among its backers, and the company's CEO says he can already see a future where artificial intelligence can replace junior traders. Joining me now is Yan Salaji, Reflexivity CEO and co-founder. Yan, thank you so much for being here. Also among your backers, Stan Druckenmiller, with whom you used to work. So you have been in the trenches with traders, right, before beginning this company. And so you well know that among that cohort, edge is what it's all about. Having an edge on your competition, having an edge in the market. How can AI help these folks have more of an edge?
Yeah, first of all, thanks for having me. It's great to be here. There are any number of ways in which I would say we're already seeing our clients, which are primarily top hedge funds, really taking advantage of AI's capabilities. I'd say the most obvious one is it's very good at taking an extraordinary amount of data and helping them connect the dots. So basically to go from that initial spark to then identifying exactly the idea, the expression of a theme, and then the trade structure. That's probably the most common use case that we currently see.
And I know that there are a lot of different organizations developing this kind of tech, either internally or other startups like yours. So, I just spoke about AI giving one the edge, but then how do you have the edge on your competitors in this market?
Yeah, I think a lot of the AI focus currently in finance, at least, seems to be primarily on unstructured data, so documents, querying, summaries, and so on. We have really focused entirely on helping you also with the structured data, so time series analysis and so on, things that are often very difficult, very time consuming to do. And we are able to not only wait for your questions in order to give you the answers, but are prompting you with questions that you should be asking but currently aren't. So the system is actively looking through the market landscape, looking through the data events, geopolitics, and so on, and then highlighting pockets that might be of interest to traders, in which case they're able to get to an idea sooner than everybody else.
Well, and so obviously that also highlights the human aspect of all of this. I mean, what role does human instinct then play in this whole process?
This, I think, is probably the most exciting part of the work that we do. So our concept is at the moment very much of the human in the loop. And what I think AI is able to do is help you stress test some of those hunches, some of those ideas. You often may make a mental leap from one idea to another, but you're uncertain whether or not the data and the evidence really bears that out. This is where AI can be extremely helpful in just quickly recalibrating whether or not your hunch is roughly in the right neighborhood or if you're way off.
As you know, it's really tough to outperform the market, especially on a consistent basis. So you guys are relatively new, but have you seen that kind of resulting outperformance in your clients?
As you say, I think that this probably is going to take a number of years to really demonstrate. But what we're seeing on a kind of anecdotal basis is that a lot of clients are very often able to find much more original expressions of the trades that they would have had. And they also find that particularly with respect to some of the downside risks, they're often able to act sooner because you have, again, a very, very focused and objective system scanning the market and then highlighting how some of these events might tie into and possibly impact the positions that you hold. So it gives you that blank slate everyday perspective.
We began this conversation by saying, some junior traders might be replaced by this kind of thing. They're the people who have been running the models in the past. So if that's the case, what do you do about a pipeline at some of these firms, right? Because you may not need to hire as many junior people, but you need those people eventually who are making the trading decisions. So how does that then get replaced? How does that work?
I think our perspective, obviously this is a very hot topic and people are discussing it everywhere, but our perspective currently is that at least as things stand, and you can see this also from the kind of demand that you see for analysts, I think the appetite for analysts remains quite high. And what is going to happen, at least in the first stages, you're going to see these analysts with tools like reflexivity become more productive, become better, become more appreciated, and so on. And we'll be able to focus on things where I think as humans, we probably do have and hold quite an edge over AI. So it's not, my view is at least over the next 3 to 5 years, it's not about some kind of a huge shift in terms of the AI versus analyst balance. It's really more about how all of these analysts get better and actually ultimately probably also enjoy their work a lot more.
Becoming cyborgs, I guess, as all of us are already on the way to doing. Yeah, and thank you so much. Really interesting stuff. Appreciate it.
Thank you for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.